And welcome to our live session today with Peter. So, what's new in the FX market?
Well, we have definitely a weakening of the US dollar. It seems like the greenback continues to suffer safe haven outflows after the relative stabilization of the market. And I would be noting here that also the Canadian dollar seems to be losing some ground. Yet that would be more understandable given that we had a slowdown of Canada's CPI rates for February, which more or less tend to solidify BOC's rather dovish stance that it intends to pause rate hikes, and that could have an adverse effect on the CAD as well. Other than that, I would note that we had from Germany the CEF indicators. They were from March, and they were worse than expected. They dropped. And they dropped both on an expectations level as well as on a current conditions level, which would imply practically that investors seem to be more pessimistic about the outlook of the Eurozone's economy, while also the conditions on the ground of Eurozone's economy seem to be deteriorating. So that's not good news for the euro, is it? And I would be also noting that we had some comments from ECB President Lagarde during today's European session, where practically the ECB President unlinked the monetary policy regarding inflation and the bank's ability to stabilize or provide aid to the financial sector should there be a crisis. So practically that highlighted a more hawkish view on the one hand regarding monetary policy, at the same time though tended to reassure the markets that the ECB has the situation under control and is ready to provide substantial aid to banks should the crisis spill over to the Eurozone. Other than that, we had also from the UK the CPI rates. The CPI rates accelerated both on a core as well as on a headline level, and both on a month-on-month as well as on a year-on-year level. And that exactly highlighted how wide the problem, the cost of living crisis in the UK actually is. I would note that we may see the release and acceleration of the CPI rates having an impact on also on BOE's interest rate decision tomorrow. Most probably will tilt the bank more towards the hawkish side.
And how have US stock markets been behaving?
Well, we had US stock markets were on the rise. It was characteristic that we had all three major US stock market indexes, that would be the Dow Jones, S&P 500, NASDAQ, all being in the greens. There is an improved market sentiment. It seems that market woes seem to be easing. It was characteristic that some stock market indexes were able to escape this wide sideways motion which characterized the movements over the past 5 days. So overall, it seems that things are looking up, at least on a fundamental level.
What about gold prices?
Gold prices had an interesting move. We noted that the US dollar was weakening yesterday. One would expect, given the negative correlation between the US dollar and gold's price, gold as a trading instrument, that gold's price would rise. It didn't. It actually dropped, and it dropped substantially. I would expect that to be linked with most probably the Fed's interest rate decision. And I would be noting that there was a comment made by Treasury Secretary Yellen, US Treasury Secretary Yellen, that should there be further mini crisis in the banking sector, we may see that reigniting practically the negative market sentiment. On the other hand though, I would expect that the easing of the market woes may also have had a slight detrimental effect on gold's price as well.
And what's on the calendar for today?
Well, definitely the Fed's interest rate decision is the main event of the day, without a question. Now, the Fed's interest rate decision splits practically into 5 points of interest. All 5 could have a substantial effect on the US dollar as such. The first would be the interest level as such. There were wide valuations, I would say wide volatility in the valuations or the expectations of the market about whether the bank will hike rates or not, and should it hike rates, to which degree. For the time being, it seems that the market's expectations over the past 2 days have started to solidify. And it's characteristic that Fed funds futures imply probability of around 82% for a 25 basis points rate hike. So that's practically a rather hawkish signal from the bank, which more or less tends to provide some support for the US dollar. On the other hand, the second issue would be the accompanying laden with its forward guidance. Should the bank actually ease on its aggressive hawkish stance, the one which was displayed by the bank up until the last meeting, we may see practically some hesitations surfacing in the market, which could weaken the USD. The third element would be the new dot plot, which is to allow us to have a sneak peek practically in the expectations of Fed policymakers about the terminal rate. Now, it's a big question whether the new terminal rate will be higher than the market expectations. Should that be the case, we may see the USD getting some support, as that would be, in our opinion, a hawkish signal from behalf of Fed policymakers that they're going to continue to hike rates and keep rates at a high level for a prolonged period of time. Mm-hmm. And I would be also noting the fourth element, which would be the new economic projections of the Fed. And it's going to be interesting to see whether the Fed expects the US economy to avoid a recession, or even should there be one, if it's going to be a shallow one. Should that be the case, that would be good news and could provide some support for the USD. Last but not least, I would be noting Fed Chairman Jerome Powell's press conference half an hour later. Powell is well known to be able to reverse the market sentiment, and he did so on a number of occasions with his press conference. So we may see volatility being extended for USD pairs. Now, should the Fed chairman actually remain confident and more or less highlight the fight of the bank against inflation, that could provide some support for US dollar. Should, on the other hand, though, the mini banking crisis of the US actually be a cause of hesitation, that could more or less create some bearish tendencies for the USD. Mm-hmm. Overall, the whole event is expected to have high volatility. So should the trader choose to actually trade, caution is advised here. That would be one. And I would also be noting that we may see ripple effects also in other markets. Say, for example, we may see also US stock markets being affected as well as gold. Should the Fed sound hawkish enough, that may cause US stock markets to drop on the prospect of further monetary policy tightening, while gold's price could also drop should the US dollar gain.
Mm-hmm. Thank you, Peter. Stay tuned for our next live session with Peter.
So, welcome to the technical analysis part of the presentation. My name is Peter Joseph, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index for chart. All charts to be presented are to be of the same time frame, unless otherwise stated. Now, what we have here is that there seems to be a continuance of the US dollar index's drop, yet I would be noting that there are also some signs of stabilization. Note how practically the pair seems to be holding around this level here. And note how practically there was a stabilization, relative stabilization in the past 24 hours. So overall, I would be noting that depending on the Fed's release, definitely the fundamentals today are going to be key. We have, I would note, the possibility of all three main directions being affected. So, for example, the US dollar could reverse direction and start going up, could intensify its drop, or could remain rather steady. So caution would be advised also on a technical level. For the time being, though, we tend to maintain a bearish outlook given that the downward trend line guiding the index since the, let's have a look, since the 15th of March seems to remain intact. And as long as the price action remains below the downward trend line, we tend to maintain our bearish outlook. And I would be noting, though, also that we have the 100 moving average, the 50 moving average, and the 20 moving average of the Bollinger Bands, all pointing downwards at different angles, but still downwards. So that's another indication that we have still a downward trend. I would be noting that we have practically an RSI indicator, which is at 32, and that could more or less imply that there's still, let me have a look again. Yeah, it's at 32. There's still some bearish sentiment left in the market for the US dollar. It's like the market has now a wait and see position. Now, should the index stabilize, we would expect it to definitely break the downward trend line. That would be a first signal of a changing trend. Yet at the same time, respect the R103.05 as well as the S102.45. So that would be a movement in the range set by the R1 and the S1. On the flip side, should the bulls take over, once again, we would expect the price action to break the downward trend line. Yet at that point, we would also expect it to break the 103.05 resistance line, a level which provided resistance here, support here, and here. There was lots of commotion, lots of breaking it around here where we had a wide sideways motion. But overall, I would say that we would require a peak higher than the R1, definitely this one, in order to start seeing a bullish outlook. In case of a bearish outlook, I would expect the price movement to drop, break the 102.45, and then start aiming for the 101.35. Be advised, there may be high volatility, and I stress the word may here, but there may be high volatility regarding the US dollar index with the Fed's interest rate decision, and it could go either way. Caution is advised, use your stop losses, and in general, be careful here. Let's have a look at EUR/USD. EUR/USD, which tends to maintain its upward momentum. And I think that the situation becomes clearer practically on three elements, four, if I may. First element would be that the upward trend line remains intact. So the bullish outlook remains intact as well. That's one. The second element, we have a slight upward slope by the 100, the 50 in green, and the Bollinger 10-day moving averages. So all these also imply a rather upside potential for the pair. I would be highlighting the fact also that Euro USD was able to break above the 1.0760, and the level actually even provided some support here. So there was a clear break. The fourth element in favor of a bullish outlook is the RSI indicator. It has just broken above the reading of 70. It's currently at 70.6, which on the one hand definitely underscores the bull's domination. On the flip side, though, maybe signaling that the pair is slowly but steadily approaching overbought levels, may become ripe for a correction lower. For the time being, though, we maintain a bullish outlook. Definitely, the R1 has to be switched into a support line, given that the price action now is above it. Give me a sec. 1.0760. Let's go hunting for a new ultimate resistance line before we make the necessary changes in the resistance support lines. This is a nice peak. And it's a nice peak. Why? Because we have a level which provided resistance here and here, but also provided support here and was aimed for here. So that's definitely, it's a well-tested level. There's no definite. And that would be the 1.75 red. Let's readjust the chart. We will have to reposition the labels and correct them. Making a start with the S3, which is now being placed at 1.0310. The S2, which is being placed at 1.0525. The S1, which is being placed at 1.0760. Overall, we have to note here that the distance between the support and the resistance lines is pretty wide, but there was wide volatility in the past days, I would say even weeks. And the R2, which is being placed at 1.1125, and the R3 at 1.1275. Let's lock everything in. There we go. Once again, we tend to maintain a bullish outlook for the pair, but as all the pairs which are to be presented today, everything is subject to the Fed's interest rate decision, given that they are all USD related measures. So it's a big question on the effect of the Fed. On the flip side, we had an ECB which remained very, very firm with Lagarde's comments today. It was characteristic that the ECB president more or less highlighted, on the one hand, exactly the ability of the bank to support European banks should there be a crisis spillover in the Eurozone as well. On the other hand, though, she unlinked the monetary policy path and the fight against inflation with any support the banks may need should there be an overspill of the crisis. And that was very distinct. She was, if I'm correct, she stated that there will be no trade-off between support for the banks and monetary policy in the fight against inflation. So that was a hawkish comment, which more or less tended to provide some support for the euro. I would note, though, that German self indicators, which were more or less worse than expected, did not affect the euro area much, or at least did not affect the euro. So there seems to be an upside bias here, which may serve the euro well. On the flip side, once again, the USD side of the pair could go anyway. Depends all on the Fed's interest rate decision. Should the bulls more or less regain their confidence, I would expect them to push Euro USD higher towards the 1.0925, a level which provided resistance once, twice, 3 times here. So it's a well-tested level. Higher than that, as the next possible stop for the bulls, we set the 1.1125, which is a little bit out of the reach, but you never know what volatility could be created by the Fed's interest rate decision. Should the pair remain rather stable, though, that's the second scenario which we should explore, then we may see Euro USD actually remaining rather in a rather sideways motion, just above or around the 1.0760 axis. Mind you that definitely for stabilization would be signaled, or if you prefer in general, a change of trend, would be signaled should the price action break the upward trend line pre-mentioned. That would be the first signal of a changing trend. While for a bearish outlook, I would expect the price action to definitely break below the 1.0760 and start aiming, if not even reach, the 1.0525. Let's have a look at GBP USD. Now, GBP USD had an interesting move. And that's being said practically as we may be about to discuss a higher peak. Now, the boys back in research suggested the following. Have a look. Let's clear all the previous trend lines, okay? Let's also have a fresh new look at cable. We can see that there are higher shows and higher peaks, with one being formed right now. So that would allow us a more long-term perspective to create an upward trend line like this. I think it becomes clearer if we drill out to the daily chart. Please allow me. Here it is. Where you can see how exactly the pair is forming higher peaks and higher troughs. Back to the 4-hour chart. Sorry, here it is. Readjusting the levels. So the upward trend line tends to highlight exactly the bullish tendencies of the pair of cable. But that's not only it. We have to note here that the 20 moving average in blue, which is the median of the Bollinger Bands, as well as the 50 moving average in green and the 100 moving average in orange, tend to have an upward slope supporting the pair, implying also a bullish outlook. And last but not least, note how the RSI indicator was able to climb from 55 all the way up to almost 70. It's actually right now at 69.7. So that's another indication that the bulls have it. Note though that the price action has not reached the upper Bollinger Band, so there's still some room to play around. It was characteristic how the pair practically flirted with the upper Bollinger Band, and that was from the, let's have a look, the 10th of March up until the 13th, before correcting or stabilizing, correcting lower, while we can see that being repeated once again here. That was the day before yesterday, yeah, the 20th of March, where it hit the upper Bollinger Band, corrected lower, hitting back on the upward trend line and taking upward swing again. So overall, we see the case for a bullish outlook to be maintained. But once again, on a fundamental level, we have to highlight a number of elements here. A, we will have today the release of the Fed's interest rate decision, okay, which could be swinging the pair to either direction. We have to note that during today's European session, we had also the UK CPI rates. They were for February. They surprised the markets by accelerating across the board. We had CPI rates accelerating on a headline level. We had CPI rates accelerating on a core level. We had CPI rates accelerating. Even a little bit more impressive was on a month-on-month basis, but on a year-on-year basis as well. So overall, I would say that in the UK economy, inflationary pressures are not just simmering under the surface here. They're actually strong. And that may force BOE to remain hawkish, whether it wants it or not. And that's a big issue for the UK economy. We're going to be seeing the effect on the pair tomorrow. For the time being, I would like to see whether there was an actual effect on cable from the release of the UK CPI rates for February. Let's drill to the minute chart. Here it is. You can see how the pair instantly jumped by 37 pips, 38 almost. And that was just at the moment of the release. You can see that there were more bullish tendencies, continuous higher peaks, higher truths, before stabilizing above the 1.20 to 65 resistance line. Now, given back to the forward chart, given that the resistance line, the R1, has been broken, and the price action has moved decisively above it, we would definitely change its role, switch its role from a resistance line to support line. That would be the first move to make. The 1.2265 is no longer a resistance line, but a support line. Let's go hunting for a new ultimate resistance line above the 1.2590. Unlocking the chart. Let's go further back to find a nice, beautiful peak. Okay, this is one definitely. But in my opinion, that's way, way too close to the price action and the R2. I would be highlighting this peak here. It's very clear that the price action was dropping. It rebounded and was able to rise, but it hit a ceiling right there. Let's see if there are any further touches. Nope, that's it. Drilling out to the daily chart, readjusting. Yeah. Let's unlock. You can see how it even provided support here, resistance here, support here, once again support here, resistance here and here. So it's a pretty valid level. It was tested a number of times and it's definitely more visible on the daily chart. So I would be placing my confidence here for the time being. back to the 4-hour chart, readjusting it. And ladies and gents, our new ultimate resistance line will be set at the 1.2760. Was a level which we had revisited a number of times in the past. Okay, let's correct now the labels. Repositioning them. Last but not least, the S3. The S3, which is now being placed at 1.1925. The S2, which is being placed at 1.2105. The S1, which is being placed at 1.2265. The R1, which is being placed at 1.2435. The R2, which is being placed at 1.2590. The R3, which is being placed at 1.2760. Once again, for the time being, we tend to maintain a bullish outlook for cable, yet we highlight that on a fundamental level, or to be more exact, on a monetary policy level, the double hit for cable, which is expected in today's American session and tomorrow's late European session from the Fed and BOE's interest rate decisions respectively, could alter the pair's direction, so be on your guard. Should the bulls though maintain control, we may see the pair aiming if not breaching the 1.2435 resistance line. On the flip side, should there be a stabilization, I wouldn't be surprised to see the pair breaking the upward trend line and revolving around the S1 1.2265 resistance support line, a level which was tested a number of times. You can see it here and here, both as a support as a resistance line. While even lower, and in case of a bearish outlook, we would expect the price action to break below the 1.2265, definitely break below that upward trend line, and clearly this time, which would be signaling, where bearish outlook would be signaled by a testing of the S2 1.2105. I would want to see the pair actually hitting the S2 before switching into a bearish mode. Okay, let's have a look at the USD JPY, where JPY weakened yesterday, if I'm correct. Yep, here it is. It's interesting how both the euro and the pound gained against the US dollar, but JPY weakened. And I would expect that to be more of a safe haven outflow matter alongside a correction, given that it has hit substantially low levels. And definitely JPY is more of a safe haven than the US dollar for the time being, at least. And that tends to make it suffer even more. So despite a weakening USD, JPY weakened even further, something which is not the case with CHF. We see that later on. For the time being, though, we note that the price action was able to break above the 132.55 resistance line, so that will have to be switched into a support line. Let's go hunting for a new ultimate resistance line. Unlocking the chart. We have a nice level here. You can see that there was some resistance. I'm keeping that with the next level being up here. Okay, that would be the, in red, 139.90. Locking it in. Maybe a little bit narrow, I know, but overall I tend to narrow the distance between the because we could be discussing also this level. That's even better. You can see a double hit here. Let's keep this one. And that would be the 140.70. We're adjusting the chart. Let's reposition the labels, sorry, and correct them. Starting with the S3, which is now being placed at 128. The S2 at 130.40. The S1, which is being placed at 132.55. The R1, which is being placed at 135. The R2, which is being placed at 137.80. And the R3 at 140.70. A little bit wide, recognize that. Okay, so let's discuss direction. There are some bullish tendencies, we have to recognize that. The fact that the pair was able to break above the 132.55 and turn it from a resistance line to a support line are a clear indication. But in my opinion, the bullish tendencies are present but are still unconvincing. And I'm saying that because we see all three major moving averages, the 100, the 50, and the 200 moving averages pointing downwards. The RSI indicator has surpassed slightly the reading of 50. It's actually at 53. That's a little bit unconclusive, yet note how the pair's RSI indicator in the forward chart has been on the rise, and that was since around the 21st of May, since yesterday. So there is an upward movement here, which should not be neglected. And I think overall, the drop of the US dollar and the rise of USD JPY are signs of the improved market sentiment. Should the bulls maintain control, we may see the pair aiming, if not reaching, the 135 resistance line, a level which provided resistance once, aimed for here twice. Also note here the touches, all the touches here. So it seems to be pretty valid. Should that be broken, the next possible stop for the bulls would be the 137.80, which is marked by this peak here. So overall, I would expect that we may see, depending on the Fed's interest rate decision, some volatile movement here. JPY is a little bit more sensitive due to carry trade reasons as well, and rather dovish BOJ. So practically should, say for example, the Fed remain hawkish, hike rates and remain hawkish, that would highlight exactly the monetary outlook differentials between BOJ and the Fed and could weigh on JPY, causing USD JPY not only to jump because of a strengthening of the US dollar, but also a weakening of JPY. On the other hand, should the bears take over, I would expect the price action to reverse direction, break the 132.55, and I would like to see nothing less than a breach, a touch, at least a testing of the 130.40 support line, a level which was aimed for here and tested here and here, but also to the upside. So it was a level which was tested multiple times and was able to constrain either an upward movement or a downward movement. Okay, let's have a look at USD CHF as promised. Now we can see that in contrast to USD JPY, which tended to be on the rise, note how the USD CHF dropped, and it even broke below the 0.9240. It was a very clear difference. Let's correct the support level as it has been broken. It was a very clear difference of behavior between two safe haven instruments, JPY and CHF. JPY weakened, CHF strengthened. And, or at least if you prefer, took advantage. CHF took advantage of USD's weakening. And I think that would be closely related with the fact that the recent banking crisis and the whole turmoil was transferred from the US and it actually hit the Swiss economy, with the Swiss National Bank being, if you prefer, the main player, had the leading role in saving Credit Suisse, or at least not saving Credit Suisse, there's a mistake, forcing UBS to take over Credit Suisse. But there is another reason, which tends to pass under the radar, and I would like to make a small mention here about SMB's interest rate decision tomorrow in the European session. So, like BOE, CHF BOE, which is going to be affecting the pound, CHF is going to be affected by SMB's interest rate decision. The bank is expected to hike rates by 25 basis points. I wouldn't be surprised to see a confident hawkish tone coming out, which could provide additional support for CHF, causing the pair to drop even further, in which case we may see it aiming for 0.9140. There is a continuous downward movement, maybe with one exception being here, but overall we see lower peaks, lower troughs. It's as if the downward motion is being maintained and a downward trend line has been formed. Something like this. Yeah. Also, there are indicators below the reading of 50. It's currently at 43, implying that there are also some bearish, a slight bearish market sentiment for the pair. So CHF, USD CHF is about to be hit with a double wham. On the one hand, we have the Fed's interest rate decision. On the other hand, later during tomorrow's Asian session, we have SMB's interest rate decision. Let's, though on a technical level, we have to correct, or if you prefer, go hunting for a new ultimate support line, given that we have turned the S1 to the new first resistance line. Okay. Here you go. We went way back, and definitely we have a touch, a new low, despite it being rather narrow. At back in August, 3rd of August 2021. That's almost 2 years back. So it's rather way back, but it's the first touch we can find. Let's lock this in at being at 0.9015. Locking it in. Let's go further back. See, there's another one, but I would prefer to take this one and then the next one being somewhere here. It's a little bit wide, but there was a wide sideways movement here. Okay. Readjusting the chart. Let's correct the labels. Making practically a new resistance line allows the pair to enter a very wide range between the R1 and the S1. Let's start correcting them, and the R3 now is being placed at 0.9440. The R2 to be placed at 0.9335. The R1, which is being placed at 0.9240. The S1, which is being placed at 0.9140. The S2, which is being placed at 0.9070. And the S3, which is being placed at 0.9015. With the last support line being pretty narrow in distance, we could widen it, but there is already a very, very wide distance between the R1 and the S1. Mind you that the boys up in research highlighted once again that the S1 could be higher, could be placed somewhere here, as we had a number of touches, and I'm going to adopt this opinion. That would be the 0.9160. So we recalibrated the S1 as well. Okay, so we are ready now to discuss direction. There's a downward movement despite the breaking here. And let me make it a little bit more visible. Here you go. So overall, there is a downward movement. The RSI indicator tends to imply that there's a slight bearish sentiment from the market regarding the pair, which may allow it to drop even further and start aiming for 0.9160. Mind you, once again, the double hit by the Fed's and SMB's interest rate decisions in the American session today and the European session tomorrow respectively could alter the pair's direction to either way. Should the bulls take over, then I would expect the price action to rise, break the 0.9240. Definitely I would require clear breaking of the downward trend line we have just drawn, and the pair to start aiming, if not even reach, the 0.9335. I would advise once again caution while trading, as we may be having a very, very volatile Fed interest rate decision, which could extend the volatility for USD pairs over a period of time. Definitely, I would be advising caution up until the Fed Chairman Powell's press conference ends, maybe a little bit longer as well. So that should be it from all of us here at IronFX. I hope you found this report useful, and best wishes for solid trading.
Hello, my name is Christina, and today I will talk about GDP. Gross domestic product is the monetary value of all goods and services produced in a nation during a given time period, usually a year. Basically, it's a record of everything bought for money during the course of 1 year. Consumer purchases from a chocolate to a car and counted in the GDP. When businesses buy computers or export goods overseas, the transactions all increase the GDP. Government spending also contributes to the GDP. A related statistic is the GDP growth, which is a percentage that shows how fast the economy is growing. If the annual rate of GDP growth is 3%, that means the economy is 3% larger than it was the previous year. The rate of GDP growth changes depending on the health of the economy. During an economic downturn, the economy contracts and GDP declines. For example, the recession that lasted from 2007 to 2009 was a severe period of economic decline. A GDP figure that shows strong economic growth means that businesses are making money and can hire people. Unemployed people are more likely to find a job and consumer spending rises, leading to more profit for businesses and even more hiring. Government leaders analyze GDP reports when creating economic policy. The US Central Bank, the Federal Reserve, uses the GDP report to gauge economic activity. Investors look for signs of sustainable economic growth in the GDP report, paying close attention to the information it contains, especially corporate profits. Business leaders analyze the economy's performance as is reflected in the GDP report so they can decide on future investment and production. As a measure of the sheer size of the economy, the GDP provides economists and ordinary citizens alike with a convenient and accurate measure of economic vitality or the lack of it. Thank you for watching.
Okay, welcome everyone to today's session. Today's session, we're going to touch on Fibonacci confluence, right? Particularly the Fibonacci confluence trading strategy. As the name suggests, right, confluence means there's not only one level there, but there are multiple Fibonacci levels that line up exactly there, right, to create a high probability reversal zone. Okay. Now, as usual, remember, if you have questions, don't hesitate to ask it anytime throughout the webinar. Right, I'll do my best to get to them, right? And of course, to begin, right, risk warning. Remember that everything in this webinar is educational in nature, so please do your own little due diligence before you guys trade. Nothing should be construed as investment or trading advice. Okay. Now, so for those of you guys who do not know who I am, my name is Desmond Leong. I run the award-winning research firm Everest Fortune Group, also a Forex Army, right? I'm finalist for the best FX and best equity research in 2019, 2020, and 2021, right? So recently been taking a couple of prop firm tests too, right? I think my Forex funds is the most recent one that we passed, right? And yeah, you know, it's today's webinar will focus on the Fibonacci confluence trading strategy and how I actually use it. All right, it's a reversal strategy. Okay, it's a reversal strategy, so it works really well when in overbought and oversold situations. But you do need to have a lot more confidence when you use it, right? Meaning that it's usually against the market. So if I have my pen over here, right? And my pen over here, usually when you're taking a reversal trade, you know, the market is going against you, right? It touches and then it reverses. This is what we call a reversal kind of contrarian style of trading. Is slightly different, right? So it's not the usual breakout trading. So most people are comfortable with a breakout trading, means that price breaks out and they play all the way down, right? This is because, you know, when price is dropping very strongly, you feel a little bit more comfortable trading the direction of price, right? But the Fibonacci confluence trading strategy is slightly different, right? It actually plays the reversal, right? It actually plays the reversal. That means you need to have a little bit more tolerance for risk, right? Especially when you see prices coming down and then you choose to play in the opposite direction. Okay, it's a lot scarier, right? But it can also be a lot more rewarding because you can get a pretty good risk to reward. Okay, now let's begin today's session. Right, I'll be touching on a couple of things here. Questions, remember to feel free to send it through directly to me. Send it in the Q&A part. I'll do my best to answer them. Okay, let's begin today's session. Okay, so let's first touch on ideal market structure. Okay, ideal market structure, right? So this is the part where okay, there you go. When you're trading Fibonacci, right? When you're trading Fibonacci, right? One of the things that you want to do is you want to look for ideal market structure, right? You don't want a market that is too it's like too messy, right? You want to look for the markets where, you know, there are very, very clear movements, right? And this is what I mean by that, right? You need the markets with very, very clear movements. You want to look for the big movements. You don't want to look for the small movements like this. Okay. Now, let's of course move on from here, right? There are two things that you need to take note of when it comes to drawing Fibonacci, which forms the basis of our entire trading strategy, right? When you draw Fibonacci, you'll notice that there's this line, there's this dotted line that goes all the way through when you're drawing it. This dotted line needs to follow price as closely as possible, right? It needs to follow price as closely as possible to be profitable, no, to be accurate and relevant, right? So in this example, when price is like moving in this direction, the Fibonacci retracement is not very effective because price tends to deviate quite far. Price tends to deviate quite far from the dotted line. You compare that with this. When you draw a Fibonacci retracement like this, from here to here, you notice how nicely price follows it, right? Even from here to here is okay, right? It deviates just a little bit. In these kind of situations, the Fibonacci is a lot more effective because it follows price more accurately. Okay, so that's the first two things that you need to take note of about market structure. Okay, that's the first two things you need to think about when you're drawing Fibonacci retracements. Your retracement should ideally follow prices price structure as closely as possible, because only then will it be can you get an accurate Fibonacci retracement. So I just need to drink a bit. My throat, oh shucks, my throat is hurting a bit, so I do excuse me if I take a couple of sips here and there. And of course, when I accidentally spill it on my mouse, oh god, just give me a second. Okay, now let's continue, right? So this is the correct way. Now, a Fibonacci, let me explain to you what's a Fibonacci retracement, a Fibonacci extension, a Fibonacci expansion, and a Fibonacci projection. Okay, there are 4 different things, and they are used differently. So if you know how to use them, that actually unlocks the secret to trading. If you ask me personally, right, unlocks the secret to trading if you know how to use this properly. Okay. So for example, Fibonacci retracement, you only pick 1 point and you pick a second point. Okay, when you pick 2 points, you then be able to your starting point and your ending point. You are trying to see how far price will then retrace upwards. Okay, so you tend to have a few traditional 23%, right? 38%, 50%, 61. This basically means like how far you're retracing. If you retrace 50% of the entire move, that means if the total drop was 100 pips, right, and you retrace 50% of the move, it means that it's a 50 pip, price has moved back up by 50 pips. Okay, so that is basically what it means by Fibonacci retracement, right? 23, 38, 50, 61, all these different numbers, it basically is simply, right, the percentage of the move, right? So if price comes down and drop all the way here, if it bounces up by 50%, it basically means that it has retraced 50 pips, right? Assuming the drop is 100 pips. And if it retraces more than that, right, this is the 61, this is the 78, right? It basically means how much of the original movement it is recovering from. Okay. Now the next thing we do is Fibonacci projection. Fibonacci projection is a little bit more complicated, but it basically means you see the starting point here and the middle point. Okay, you are taking the distance of the starting point to the middle point, right? You're taking the distance, like let's just say the distance is 100 pips, right? And you are projecting it onto here, which is another 100 pips, right? So that is what it means by 100% Fibonacci projection. Okay, it means that you're looking for price to touch and then bounce from there. Okay, we are looking for price to touch and then bounce from there. So that is basically what a Fibonacci projection means, right? I'm going to erase it over here. I'm going to draw it again for you. Very simply, Fibonacci projection means that you're taking the distance from, if you have a movement like this, you're taking this movement. It could be 100 pips, and you're projecting it over here, maybe another 100 pips. This is what I mean by a 100% Fibonacci projection over here, right? So we have stuff like the 100%, we have the 61% projection, we got the 78% projection. All of it basically means that, you're taking the distance and you're multiplying it by 61, 78, or 100, right? When you're forecasting when the reversal is going to happen. That is the meaning of Fibonacci projection. Now let's talk about Fibonacci expansion. It kind of looks like the same thing, but you only have one starting point and one ending point. Price must minimally retrace at least 50%, minimally 50%. So if it retraces to 61 or 78, it's fine. What then happens is that you forecast price to go up to reverse off the negative 27% level, right? And you can see that has happened very nicely over here, right? So this is the trick to Fibonacci expansion, right? You are literally just forecasting when price is going to reverse, okay? You're literally just forecasting when price is going to reverse right here. Okay, it's a very, very important rule too, right? Because it is one of the few market leading indicators out there, right? It's one of the few market leading indicators to help you like forecast at what point in the future is price going to reverse. Very few other indicators are able to do that. Okay, guys. Now the last one I'll talk about is called Fibonacci extension, right? So Fibonacci extension, I call it like a Nike tick. You have your starting point of your Fibonacci retracement here and your ending point over here. It will then retrace two key levels, 127 and 161.8. Those are the important Fibonacci levels that you need to refer to. Okay, and once you rise up, right? Once you rise up to the 127 and 161, what happens is that price tends to reverse from that level. Okay, so that is what we call a Nike tick. Nike tick is very, very straightforward. Okay, a very, very straightforward setup, right? And you're looking to play the reversal from the 127% or the 161.8%. I'll be showing you some examples of this later. But the key thing here is that we have looked at Fibonacci retracement, extension, projection, and extension. The four Fibonacci, four types of Fibonacci. How we're going to use that is this concept called confluence. Okay, it's this concept called confluence, right? So as you can see, we can start with the Fibonacci projection, 100%. We can start the Fibonacci retracement, expansion, extension, and we found 1, 2, 3 reasons why price might bounce off this area. So this is the meaning of confluence, right? You line all of them up together, it creates a nice area. And what happens is that when price tests that level, tests the area, it tends to reverse very nicely, right? Because you have not only 1, but you have 2 and 3 reasons why price might bounce from that level. Okay, so that is the concept of Fibonacci confluence, right? You don't just trade it you don't just use a single Fibonacci to trade it. You combine multiple of them together to be able to execute the trade, right? Usually it's a reversal trade. Okay, guys. Now let's look at some examples, right? So we take some time to look at a couple of examples on using Fibonacci confluence. Okay. Just I probably need to turn off my video over here just so that it doesn't mess with the charts. Sorry, just let me load this. Let me just make a copy, right? Okay, let me show you some examples of Fibonacci confluence. We try to look for them together. Oh, sorry. We try to look for them together, okay? So I usually have my Fibonacci retracements when I draw it. I have this thing, all the different Fibonacci levels over there. When I use all Fibs, okay? When I use all Fibs, it actually shows me everything. So over here, the middle part is what I call Fibonacci retracement. And once it retraces beyond the 100%, this is what we call Fibonacci extension, EXT. And if it comes down here and it comes further down, this is what we call Fibonacci expansion. Okay, these are the three types of Fibonacci, right? We got the retracement, we got the extension, and we got the expansion. And these three will actually unlock a lot of the key secrets, so how you can call reversals. Okay, let's take a look at some examples. We're looking at euro dollar now. Actually, let's look at pound dollar. When you draw a Fibonacci here to here, what do you notice, right? I'm just going to highlight one key level, 127%. You would notice I'm going to do a bar replay feature over here, right? That price actually went all the way up, right? Price went all the way down. It went all the way up. It touched the 127% and it retraced back to the 100%. This is a very, very good trading strategy, which I use by myself, right? I use myself and I reached a decent amount of profit, right? I see if I have the picture over here, right? But basically, just let me see if I have it. There you go. You know, it's a good 8% that we made over here already. So as you can see, let's do a save as a detailed report. Yep, detailed report. There you go, right? Yeah, basically it's a good amount of trades that you see over here, right? You got about 8% profit, right? With a 2% drawdown. It's enough to 2.7% drawdown, 80% win rate for short position, 50% win rate for long positions, right? Right. Most of our trades were profitable, 65%. So it's a nice 65% hit rate, right? Pretty good risk to reward. Like average profit is 1147, average loss is 920. So you know, managed to make pretty good, decent money with this setup. Okay. Now it is the setups I took was purely from here, right? We take the reversal of the 127 and play it down to the 100%. Okay. Now the success of this strategy lies in confluence. Sorry, just give me a second. The success of this strategy lies in confluence. Okay, what do I mean by confluence? In this particular setup, right? If I were to do a bar replay feature, so I think it was a 4-hour chart. Right, in this particular setup, when we did the Fibonacci retracement, Fibonacci extension, I noticed there's a 127 over here. The 127 also happened to line up with this swing high resistance. Okay, this multiple swing high resistance, meaning that I have 127, I got one swing high, I got two swing high. So it's a high enough chance, you know, we got one, we got two, we got three reasons why price might touch this level and reverse. Okay, we got three reasons why price might touch this level and reverse. And true enough, from there, right, let's go bar by bar. Right, price actually comes up here, touches this level, and reverses very nicely. You can see it reversed and it reached our 100%. So this is what I call the Nike tick strategy. Right, you're really just looking to play the reversal of 127 all the way down to 100. How you can improve this strategy is one of it, of course, having a very clear Nike tick, right, very clear V that you're looking for. The other is when you combine it with support and resistance. In this case, we got swing high, right? Price reacted once, reacted twice. When price finally came up again, it was going to react again. So there were three reasons why price was going to drop. Okay, combine that at 127% extension, the Nike tick kind of Fibonacci extension, you got even higher probability trading strategy. Okay. Now, of course, you can combine it with different forms of Fibonacci. Let's try to see if I can find any over here. Let's see. I'm trying to find one with a little bit of a Fibonacci projection tool. Let me see if I can find a good example with one with a Fibonacci projection. Okay, this is one example. This is one example over here. So let me just make sure I get this right. So as you can see over here, right, very nice Fibonacci extension. This is a nice little Nike tick that you're looking at, right? You can see it's a very, very nice Nike tick. And it comes all the way up to here, this 127. Okay, I'm going to leave this 127% over here. Because at the same time, there's a very nice Fibonacci expansion, right? Remember the rule for Fibonacci expansion. The rule for Fibonacci expansion is that price needs to minimally retrace 50% of the entire move, right, before you can consider a bounce, right? So we got over here 127 and negative 27. So what we call a confluence area. This is a confluence area. Okay, so what then happens is that we wait for price to reverse from this level and play the move down all the way down to here. This would be where we play the reversal from and until. Okay, so here we go, right? So we can see price, bar by bar, it starts to reverse, There we go. And price will have hit our take profit then. Okay. It's a simple enough reversal that you're looking for, but you notice that I will not trade based on the 127 alone. I mean, based on 127 over here, right, a zigzag Nike tick, right, 127 is already pretty strong, right? But if you throw in this Fibonacci expansion with a negative 27 up here, them combined, right, actually causes, it gives you a much more higher probability setup, okay? Now, if you really, really want to really improve your probability of you getting a good trade, I believe you could throw in a little bit of RSI. Because you can see over here for the RSI, right, when price was starting to do the reversal at the key level, right, it was a bearish divergence. Bearish divergence. And bearish divergence is when the price, the highs of the price is going higher, means it's climbing, right? And in this case, stochastic RSI is going down. So in this example, right, it's a bearish divergence, right? We have not only the 127, we have not only the negative 27, right? We also have a bearish divergence versus stochastic, no, versus RSI. So that gives you a good probability that price is gonna drop. Okay. Okay, I see a couple more people over here, right? Let's see, Mr. John, right? Yosef, right? Damir, Mr. Damir, are you around? I just want to make sure that you can hear me clearly, right? If you can hear me clearly, feel free to send a message in the chat. All right, Mr. Damir, right? Okay, let's continue today's session, right? So this is an example of finding a Fibonacci expansion along with a Fibonacci extension. So this is expansion plus extension plus divergence. Okay. All three of it lining up very nicely to call this reversal over here. Okay, let me try to look for a couple more examples. Right, so we got Kiwi dollar. Okay, there we go. This example, I should be able to show you a little bit more confluence over here. So I tend to look out the I tend to use the Fibonacci extension as the leading indicator of what might happen. So the Fibonacci extension usually works when you start to spot a letter V. Whether it's a V or inverse letter V, the moment you see it, right, it is time for you to start mapping out your Fibonacci extension, right? So the moment I notice this letter V over here, whether it's an inverse V, I start drawing a Fibonacci retracement from one place to another place. Okay, now that it's over here, what I then do is I will highlight the 127% Fibonacci extension over here. Okay, so we're looking for the reversal for price to come all the way down to here, touch this 127 and come back up to the 100%. Okay, it sounds like a simple enough setup, but if you get it wrong, it can be very dangerous. Okay, so 127 over there. Okay, let's see how price actually panned out. Bar by bar, you can see it go down, go down, go down, go down, go down. It touched the entry, right? And it bounced back up to the 100%. It might even bounce before that, but yeah, it bounced up to the 100%, right? You see it come down, touch the 127, then it do a small little nice bounce. So this move is all you need to make money, right? You don't care about what happens after that, but this move is all you need to make money. Okay, so that's another example of using the 127 Fibonacci extension, right? I'm going to try to find an example for you where there's a Fibonacci projection. Okay, we got another example over here. Okay, in this example, right, we can see that price is starting to create a nice little ladder V, right? As you can see over here, right? It's starting to rise up nicely and it's starting to reverse. Okay, we look at the 127% extension over here and we're like, okay, looks interesting. I then do a Fibonacci projection with this as the top, the middle, the ending point. What we then notice, right, I'm just going to remove everything and leave the 127 over there, is that there is a 127 and there's a 78.6 Fibonacci projection, right? So it's all lining up over here, this area over here. That means my pending order will be in this region, okay? What happens when it's like this, right? We can see, let's show you. Price pass, touches that level, and it bounces back up, right? So you have been able to play this little bounce here, making you a fair bit of money, right? So it's all about finding the extension level and combining it with like other forms of technical analysis. You can use the Fibonacci projection, you can use a Fibonacci expansion, and you can use a Fibonacci retracement. So if you were to use a Fibonacci retracement in this circumstance, let me see if it works out. Usually it's a lot harder. Yes, usually a lot harder. Yeah, okay. We'll leave that out. Okay, so that is a great example of using Fibonacci extension with Fibonacci projection, right? I'm going to go through a couple more examples, guys. If you have questions, please ask them, right? Don't hesitate to ask them, all right? Try and find a few other good examples of Fibonacci. There we go, right? This is another really, really nice example, which might just line up with a bigger retracement story. Nope, right? But it might line up on the shorter term time frame. Let me see. You can see that price actually goes all the way down over here, and it's starting to form a nice little Nike tick, right? And it actually comes all the way here, touch the 127, right? And then reverse back down to the 100%. Okay, so this is another example of using a Fibonacci extension. The trick, guys, is really in finding the tick. It's not easy to find the tick, but once you find the tick, you know, you're a lot trading is a lot easier for you, right? The trick is really in finding the tick. Let me see, even in such a situation, can you find a tick? Yes, you can, right? And if you can find the tick, you probably can find the extension. Okay, you can find that. Okay, let me show you another example, a really, really good example. Okay. We can see price over here, right? It looks like it's going to form a nice little reverse Nike tick. Okay, so we take a Fibonacci retracement. We start from the bottom here and to the top. Okay, we got a nice 127% Fibonacci extension about there. At the same time, you know, you have a nice little Fibonacci expansion. Price goes down, retraces minimally 50%, right? But it doesn't kill you off completely. You know, so here you go, retrace minimally 50%. In this case, it retraces all the way up to here, then looking for the move down. Okay, so here we go. Here, touch the 78.6, and we can see a negative 27% all the way down to here. This lines up with a 127% Fibonacci extension too. And of course, we got one more level, which is the major Fibonacci projection, right? From here, all the way down, all the way up. And we have a 61.8 Fibonacci projection here. So we got 1, 2, 3. We got 1, 2, 3 reasons why price might bounce, right? So we're going to highlight this area over here. Okay, I'm going to highlight this area over here. And what we're expecting is for price to actually come down, touch this level, and bounce up minimally to this level where it kind of broke out from. Okay, and this happens way too often, right? We can actually see price come down, come down, come down. Test that level, and then it bounced up, as you can see over here. It bounced up and it kind of hit this take profit. Okay, this is one of the beauties of Fibonacci confluence, right? You find an extension, you find a retracement, you find a projection, you find an expansion, extension, right? All of it lining up together, at least 3 of them lining up together. It gives you a really good setup where you can play a small little bounce from the entry to the breakout level, the 100% where you were at. Okay, guys, you know, you can combine this with support and resistance. You can combine this with trend lines. You can also combine this with Fibonacci, right? So the key is what I call Fibonacci confluence. Try to at least find 2. You can find 2 that lines up is great, right? So you got your Fibonacci extension, right? You got Fibonacci retracement over here. You got Fibonacci expansion, and you got Fibonacci projection. Okay, this fall you minimally must have 2. I usually like to find retracements with projections. They tend to work very well. I like to find extensions with projections too. Okay, I really like to find extensions with projections when they line up over here. 127 and the 61.8 usually works out quite well. Projections and retracements work quite well. Extensions and retracements also work out quite well, right? And of course, extension and expansions tend to work a little bit less, right? But they can work out well. As a supporting argument, if you get expansion after having the rest, right, it's worth consideration, but I will not use it by itself, right? So I kind of put this maybe in red. Yeah. So if it's a expansion with anything else, it's not effective. But if an expansion as a supplement to the other Fibonacci's, right, it's actually a pretty good setup. Okay. Now, guys, I spent a good 40 minutes explaining Fibonacci to you guys. I'm just going to open the floor for 1 minute for anyone who has questions regarding today's webinar. Right? Does anyone have questions regarding today's webinar? Okay, so now that I'm moving away from from the slides, no, from the charts. Turn on my video again. Does anyone have any questions regarding today's webinar? Right, if you know how to master Fibonacci well, it will really help you when you're finding confluence. You know, when finding reversal, it's very effective in finding reversals, less effective in finding breakouts. Okay, now, okay, I can see that, you know, there's not many questions coming through, and I appreciate that. I hope the explanation was clear for you guys. Right, thanks for taking the time to come to today's webinar. Right, I hope you found today's session useful. Apply in your trading, whether it's any form of retrace Fibonacci. If you can use it to combine and find areas of confluence, not only with Fibonacci but with other support and resistance, with other price action levels, right, you can actually come up with a very good trading strategy. Okay, now that's it for me, guys, today. Thank you very much for staying throughout. Right, if you have no questions, end today's session. I'll catch you tomorrow for a live trading session. Stay safe, trade safe, and I'll catch you guys tomorrow and next week.